Hey, welcome to a Sunday afternoon. My apologies, but I appreciate you guys bearing with me. My wife is off taking care of a stepmother, and the fact that she just lost her stepbrother throws things into a mess. Greatly appreciate your understanding, and I greatly appreciate you guys in general, just working with me on these type of things. The joy of having 6 kids, and it feels like I live a very hectic life. With that said, today I want to let's make sure I've got the right size where we can actually see all these. I want to go over how a collar trade process works. I keep getting this, and yes, this is more for William. So William, as you listen to this, this is one more time for you. Jeff Schaffner, I think it'll help you out. And people that are still in Boeing, I think this will help you out. People who are in Under Armour see this process going on right now. So let me work through a couple things to help you understand. Usually, we like to start with 1,000 shares. And that comes back in the past where we would, plain and simply, we wanted to maximize commissions. Now that there are no commissions on purchasing shares, it doesn't matter. But with 1,000 shares, it works easier. 500 shares will work for collar trading, and minimum is 300 shares. If you can't purchase 300 shares, you probably shouldn't be in the stock and probably shouldn't think that you can collar trade. Now, there's a reason why, and I'm going to come up with just a standard how I work through my collar trade. Plain and simple. And I'm just going to say you buy to open 1,000 shares. Bad spelling there. Shares at a $100 price, which equals 1,000 times 100, which is going to be equal to 100,000, right? You just count up all the zeros. What is your risk in the trade on a per share basis? And obviously that risk is every penny you purchased of the stock. It's $100 per share. It's $100,000. Excuse me, $100,000 if you bought 1,000 shares. That is your risk. That could go to zero. Technically, you don't go to zero, but the fact that you could lose half of your value of your share price should not surprise anyone. To lose 50% happens all the time. It's what you should expect. If you don't expect it, I'm going to scratch my head a little bit because you should expect it. That happens all the time. With that said, you buy to open a $100 long put for usually like $6 or $7 per share. Your new cost basis is the $100 stock price plus the $7 long put price, which equals a whopping $107. But the new risk in the trade, is equal to only $7. The long put, you bought the right to sell stock for a certain price for a certain period of time, usually for 2.5, 3 months, it costs between 6 or 7% of the value of the stock. You only have $7 of risk. You protected 93% of the total invested capital. Something a short call doesn't do. For a full collar trade, you sell to open a 115, maybe a 120. Let's go a 120 short call. Again, going out 2.5, 3 months, you usually get 3%, so you get $3. Overall cost basis is equal to your 107 minus the $3 of credit. So you're usually taking about 4% risk. Your overall risk, as I just said, is $4, or roughly 4% of your total invested capital. And this is how you set up a collar trade. Now, this is normally when I would ask, how much does your stock fall at earnings? And you guys would tell me, I'm going to make a run up here, and I'm just going to go to Under Armour because there are a lot of people that are in Under Armour. And if we pull up a chart on Under Armour, we can see the stock went from 1137 down to 715, 11 to 8, 11 to 9. If I even pull this out just a little bit more, we could see that, for crying out loud, there are times when the stupid thing goes from 21 down to 7. So there's a 60% drop. Let's run the 60% drop just because it's fun, just because I showed you it happens. Let's run this drop from 21 down to here. More likely to use that one, more likely to use this one, more likely to use this one. So 60% is not out of the question. 30% is more common. I'll give you guys that. But let's just take a quick peek. Let's take a quick peek. Let's see what that would do. Falls 60%, like Under Armour, right? So our $100 stock is trading at 60 bucks. Excuse me, at $40. It just lost 60%. What do we do? Well, this is interesting because if the stock loses 10%, right, it equals $90, and we still have the right to sell at 100, which means literally if we take that 1,000 shares, that $100,000, right? I love building this chart. We take the $100,000 and divide it by $90. We come up with 1,111 shares of stock. If the stock price loses 20%, means it's at $80, right? And I'm actually just going to start to copy this part because it'll be easier. Right, to sell at 100. If we go ahead and we take 100,000 and divide it by $80 a share, we now have the right to pick up, or we could go in and buy 1,250 shares. Sorry, this is just, for me, this is fun. For me, this is everything that I enjoy figuring out, right? Loses 30%, it means it's at $70 a share. I don't know why this is acting that way. Layout. Got a little weird thing in there. All right, if it loses 30, again, we take that $100,000 and divide it by $70. All of a sudden, notice how almost exponentially it starts to get better when you're picking up these shares. It's just ridiculous. Why is it doing that? That's really bothering me. Well, now we're gonna have a little space. Dang it, that bugs me. All right, I'm just gonna keep going. We lose 40%. It equals the price is now at 60. You take 100,000, divide it by 60. All of a sudden you have 1,666 shares. We lose 50%, which means it's at $50 a share. Plain and simple, we can pick up 2,000 shares. And the neat part is, if it loses 60% where we're at with Under Armour during that period of time, means it's only equal to $40. And if we take $100,000, divide it by 40, you actually come up with 2,500 shares of stock. This is where we get to pick up shares of stock, dollar cost averaging, without asking you to invest more capital. Kevin, but that's not true. That is true, because we won't take this 11 shares. We'll keep that for buying your new long puts. We won't take that 50, that 28, that 66. Even though we can pick up 2,000, we may only pick up 1,900. Even though we can pick up 2,500, we only may pick up 2,400. We're going to save some cash to purchase some more, quote unquote, we're going to purchase some more shares of stock. Now, people ask me all the time, why do you do this? Why is this so important? And it's funny because US stock market crashes. And I think I've got this somewhere in here. Nope, I don't want that one. Oh, come on. US stock market crashes. Let's try this. There it is. Pretty sure this is the one I like. Yep. So what I did is I picked this up and I grabbed it from just the US ones. And there's some weird ones in here. You know, Panic of 1819, 1857. What I did is I chose what was maybe more relevant to us. Let me find where I grabbed that. And it looks like, in all honesty, wow, I really went back more than I should have. What I did is I took it from the May 17th, the Panic of 1901. And in all reality, you shouldn't really worry about any of this, since I'm going to say for myself, 1990. I didn't start investing till the 2000s. But here I put all this in here. And really interesting. These are market crashes. Look at the last 5, maybe the last 6, right? 5 of the last market crashes happened in 15, 11, 10, 8 was really a crash, 7, 2000 was really a crash. So we had 6 in the last 20 years. Means on average 3.33 years we get a market crash. There are some other ones that are more interesting in here because some people will look at this and go, well, Kevin, you know, things weren't too bad 1990, 1987. I mean, we really run through some that we think of, well, not really as bad as you think. If you're not understanding the history of the stock market. In all honesty, I think they're missing right in here the crash of 1997. I remember this crash. This was the Asian contagion crash. It was one of the biggest Dow Jones single day percentage losses ever. They called it a mini crash because it was only the 18th biggest Dow Jones industrial loss. Ooh, only the 18th. But that was a pretty wicked day. We've got another one in here. The 1994. It's the NASDAQ crash. From spring to summer of 1994, the NASDAQ crashed 14%. I think it's ridiculous. Where is the 1981 to 83 crash? I kind of call it the Peanut Carter crash, right? But the reality is, this was the early 80s recession. This was a labor recession. This was a savings and loans crisis. Huge drop in our stock market. In fact, even worse, we're completely missing the 1968, and some people will call this the Vietnam crash, which is not correct. It's the 1968 to 70, 50% drop in the markets, high unemployment, high inflation. It was the subcursor to the 80s crash. 20-month, 50% drop in our stock market, not listed here. Guys, crashes happen all the time. Significant crashes in our bull market, in my opinion, are listed right here. Haven't run a bull market since 2008 till now. Well, yeah, but you forgot about the flash crash in 2010. You forgot about the ultra quick short-term bear market decline of 20.58%. You forgot about the August 2015, where we had a huge drop in 2 days. I don't see why memory is so short-lived. And even this one, I brought up those other crashes. You have to understand this is how markets work. Markets work this way all the time. If you're not prepared, if you're not paying attention, if you're buy and hold, if you're in a mutual fund, you're getting your butt handed to you and you don't even know it. I can't make the case for collar trading any more than I am right now. With that said, here is the hardest part. The hardest part of being in the market is being able to wait for the stocks to come back. Now, let me put this in plain English. If you're a billionaire, it's easy to see your market lose 50%. You know, you could go from $1 billion down to $500,000. You're probably going to make it just fine and have food on your table, pay your mortgage. You'll be okay. For everyday Americans, how stupid is it for you to wait for things to come back, not getting anything for what your money manager is doing? It's dumb. It's just absolutely asinine. And from the 90s through 2012, let me take that back. Since 98 to 2010 or 2000 to 2013, you had zero growth. With mutual fund fees and advisor fees, your guy did nothing for you. If you have someone right now that's stock picking and not doing anything to protect you to the downside, you have someone that is doing nothing for you. Stop using them. It's not going to help you out when it's all said and done. In fact, if anything, it's just going to cost you more money. That is why we collar trade. That is why we see if things are going to get better, and that's why we make up something. We try to make up something on the way down, even if we can't pick up another 100 shares, which increases every 10% you go up, it's like going up 11%. Or if you get a 50% drop and add 1,000% more shares, right? 100% more shares, excuse me. Every 1% up is like 2% up. It's amazing. That's where we're at. That's why we collar trade. In the last 20 years, we've had 6 crashes. Every 3.33 years, the market loses 20% or more. What is your advisor doing for you? Where our markets end this week, I'm going to say higher. I'm just following the trend. I've been in a pretty good range right now. S&P still has strength in areas to go higher, both on the RSI and on the Williams percent R, although we'll probably be pretty flat this week. NASDAQ, same thing. I'm still saying a 0% growth in October, which might be pretty hard because we do have some growth. I should probably change that. I'm going to say a positive 2%. I'm going to make this a little bit different. I'm going to say a positive 2% will be the first October I can remember in forever that we're going to have it be positive for the month, but we'll take it. Earnings this week, Halliburton, IBM, Zions Bank, probably not going to be too good on Monday. Pretty interesting. Lockheed Martin, Philip Morris, Procter & Gamble, Netflix, Snap. Don't know where those are going to go. Wednesday, Las Vegas stands, Verizon, Abbott, Valmont, Tesla, KeyCorp, Alaska Airlines. I think I typed that in wrong. I did. It's not all. It's American Airlines, Arch Coal, AT&T, Carnival Cruise Line, Coke, KMB, New Skin, Siri, Amazon, big one. Intel will be a big one. What am I missing? UNP, United Pacific Railways, First Horizon National, Honeywell on Friday. Pretty light week for economic reports. Housing starts and building permits on Tuesday. Existing home sales leading indicators on Thursday with initial claims. Monday, we'll have our China GDP retail sales and industrial production. I would dare say our Monday morning futures will be based on these Chinese economic reports. Still trying getting protection, and we're just waiting for our earnings that are coming through. Again, this week, KeyCorp's the big one. Next week, Apple, Boeing, Eli Lilly, Ford, Facebook, Visa. Next week will be, then 2 weeks will be our big week. Next week or this coming week, pretty tame. A very interesting article on China snapping up government bonds, and it's not just for the return. In all honesty, currency still moves our markets. Until you understand currency and how currency affects markets, you'll never understand the stock market till you understand currency. When you watch where big money moves around, that is going to give you a heads up on where your market's going to be going. That's why, for all intents and purposes, you've heard people on TV say US is still the best market. Huge tranches of money have been pouring into the US stock market. It's absolutely amazing. Great article. Please read through it to better understand how currency affects stock markets and move into money. Day 2 of Amy Coney Barrett's confirmation hearings. I really love the lady. I don't care if you're Democrat or Republican. Plain simple, it's the president and Senate's job to really fill spots in the Supreme Court and the federal courts. Shame on Trump and Biden for being a bunch of lazy sons of a bitches and leaving, 900 spots to fill. I guess it wasn't something they felt was important because they thought that Hillary Clinton was going to win. Shame on them. They should have done their job. Now it's being filled with conservatives, and for the liberals, I guess it teaches them right. Do your job when you have the opportunity. Don't procrastinate. Buffett quoting partner Munger saying there are 3 ways to go broke: liquor, ladies, and leverage. I'm not going to comment on the liquors or ladies. I don't do either. But over leveraging yourself is huge. A lot of people have asked and looked at accounts and said, well, it seems like I'm all in leap calls right now. For the most part, those leap calls were done from profits on your stock ownership positions. I do use leap as stock replacement, but I love using leaps when I can do it just using profits. And when I'm able to do that, in all reality, all I'm doing is lowering your risk using leverage. Leverage can be risky at times. It also allows you to lessen the risk in your positions. Definitely take the time to learn that. I love seeing Warren Buffett's big drops. Goes to show you one more time, if Buffett can lose these big amounts, then of course your money manager can, as well as your mutual fund can. You better pay attention to where your money's at and what your guy's doing for you. It's just shocking how people just let it ride. Walmart divides Black Friday into 3 separate events that kick off online. Very important to read how people are fighting against, not fighting, but I guess how they're going against Amazon. Income generator here came up with an amazing. Bank of America highlighted a big problem. And again, it comes nothing down to, if you read through it, at least the way I read through it, it comes nothing down to needing a high yield curve. But do go through and read this. It'll be interesting to get a heads up on where some of the risks are with Bank of America. And then more importantly, we have a separate article that talks about perfection not needed and where Bank of America can go in the next 3 years. A really interesting article that, again, just looking at it a little separately without the yield curve, but looking at what they are currently doing and where they're going to go to. Guys, again, I appreciate you being with me and working with me. I will get this uploaded here and send this out to you guys tonight, being Sunday evening. You will not catch me live Monday or Tuesday. Keith will fill in for Thursday. Guys, have an excellent week. I appreciate your understanding one more time. I know it's not like a broken record. Thank you, thank you, thank you, and I'll talk to you again next week. Bye-bye.